We've got a lot of information to cover today. It has been a very busy day from an economic data front. It's Thursday, May 28th, and this is Markets with Megan. If you like this podcast, you can subscribe to it. Hit that alarm bell at the bottom. You can also share it with friends, your family members, colleagues, anybody who really digs into some of this economic data and what does it truly mean, deciphering between those headlines and what the actual underlying data means for you and your investments. So let's dig right in. First of all, we got basically I'm going to break it into three parts: housing, inflation, and the economy. From a housing standpoint, new home sales came out. They did fall the most that they have in 3 months. There was a decline in 3 out of the 4 regions. That's the Northeast, Midwest, and South. The only area that saw an increase was the West. The biggest takeaway out of this report is that the median price of a new home sale jumped 8% in the month alone. This is the most that we've seen since April of 2019. This is not good news from an inflation standpoint as we get into that data. Inflation. So inflation for April, we've got the Fed's preferred core PCE measure. This is what the Fed likes to look at. It did rise relatively in line with expectations, but remember, expectations were already high. We saw at the core level, inflation is rising 3.3% on a year-over-year basis. That's the highest since 2023. The headline rose 3.8%. That's the highest also since 2023. Now at the core level, we've talked about this. This has been driven by software, technology, also healthcare and financial services. The software and technology has been the increase in prices that we have because of the disruptions with the war with Iran. And headline also, that was driven by gasoline. Again, a war impact. We also saw in that same report that real personal spending is getting squeezed by these higher costs. So consumer spending, when you adjust it for inflation, only rose 0.1% in April. And real disposable income, so again, adjusting for inflation, that fell for the 3rd consecutive month. The last time we had 3 consecutive months of declines in real disposable income was at the end of 2021, early 2022. Again, that was after the COVID-related inflation spike. The savings rate, because consumers are having to dip into savings to pay for these higher costs, that plummeted to 2.6%, the lowest we've seen since 2022. And if you look at these new home sales data, inflation, when we get the consumer price index, it has a big portion of that is housing. So when you're looking at those medium home prices jump like that, that's just likely to filter into those inflation data as we get that in the coming weeks. Now, from an economic standpoint, we got the second reading on the first quarter GDP. Again, it's backward looking, but it was revised lower from 2% to 1.6%. The 2 main reasons were weaker consumer spending at 1.4% on a quarter over quarter basis. That's the weakest since the first quarter of last year. And then also slightly lower non-residential fixed investment. So this is where the CapEx spending for AI falls. Even though it was a little bit less than the original forecast, it still is rising 7% on a quarter over quarter basis. We also got that preliminary durable goods number. This goes into GDP for the second quarter. That was for the month of April, and the headline level, that jumped 7.9%. The best in 11 months. Now, it was primarily led by defense spending, which rose 7% in April, following the 26% increase in March. This is all defense spending related to the war with Iran. Now, at a dollar level, it's at the second highest level on record. So what does this data mean here for the second quarter? Right now, that durable goods numbers, those were strong. So that's feeding into some of the expectations for the second quarter. If you look at the Atlanta Fed GDP model, that's showing that growth is tracking about 3.8% for this quarter. Now, what does this mean for the Fed, for the markets going forward, for the economy? It's a very mixed economic picture right now. Obviously, consumers are strained by the higher prices. Equity markets are still making record highs. That's because there is expectation this war will end soon. The expectation for the Fed is now that they may have to hike interest rates. We don't think these inflation numbers are done. We've said this repeatedly. Even if the war were to end today. There is a bottleneck that will take time to clear out of that Strait of Hormuz. Prices will remain elevated until we can completely normalize that. And if we've seen anything in the past, it does not happen overnight. So be prepared for some more higher inflation numbers. We're not so sure yet the Fed's going to have to hike rates this year. We would lean to a higher probability that they would hike than cut. We definitely don't think there's cuts on the table, but we want to see a little bit more inflation and then what does materialize with the talks we've seen with the White House and Iran. That's all we have today. If you want a history of our podcast, you can go to marketswithmegan.fm. Thank you.